Good evening, everyone. Welcome to our Georgia Tech Alumni Homebuyer Workshop. My name is Jason Maida. Great to be with all of you this evening. Appreciate you taking some time out of your busy schedules this week to join us to learn a little bit about the journey towards homeownership. So we promise to provide a lot of great content to you tonight to really help you understand a little bit more about homeownership. Our class will run just about an hour, so within that hour time frame, you're going to learn a lot of great valuable tools on homeownership. We're going to kind of talk a little bit about key elements that make up that journey towards achieving that financial goal. And we try to make this a very interactive session. So as I move through tonight's session, we're obviously going to provide you some content, but love to be able to get your feedback. Any questions that you have, you can drop those in the chat or Q&A. Myself and my colleague Ken will be kind of monitoring those windows and answer questions for you. We are also recording tonight's class, so we'll have that up on our YouTube channel tomorrow. You can take a peek at that. We'll also pass along all of our slides for tonight. Well, we're excited for you to be a part of tonight's class. Again, my name is Jason. I'll be your presenter this evening. I work for an organization called American Pacific Mortgage. We're the 9th largest lender in the country, and our team in particular focuses on giving or pouring in education to our local communities across the country through our alumni partnerships like the Georgia Tech Alumni. And so I'm really excited to be able to share some of this information for you. And this class is provided 4 times a year, so it's offered quarterly. And we usually have really good attendance through Tech Alumni, and we've been have the pleasure of helping fellow alum be able to actually purchase their homes throughout the year. In fact, right now we have one of your own fellow alum that's purchasing a home in the Atlanta area. Really excited to get them the keys to their home early next month. So, they were an example of one of our attendees to one of our classes last year, and I'm glad that we're helping them on the journey. And of course, you can have that same experience too. But we want to first be able to provide some really great information to you to help make a good financial decision, really. So a lot of things that make up homeownership, and face it, this is probably one of the biggest financial decisions you're going to make. So obviously you're taking time out of your Thursday evening to listen to me talk for an hour. So clearly you understand kind of the magnitude of this kind of decision. Now, here's our talking points for tonight. We're going to look at the housing markets, find out kind of what's happening with home prices, inventory levels. We'll also spend some time looking at interest rates and what's happening with interest rates and the volatility we're experiencing currently in the mortgage world. I also want to walk you through a rent versus buying scenario. Like, does it make sense for me to consider buying? So if I'm looking at my current rent situation, does it really make a lot of financial sense for me to kind of dive into mortgage? And then we'll also talk a little bit about credit and how do I maybe look at areas of opportunity within my own credit score. And so I'll kind of help you through that. We'll talk about loan programs that are available to you, include some terminology that you've probably heard before. And then we want to talk a little bit about savings for home ownership. How do we save up for down payment and closing costs when it comes to purchasing my home? And also different resources that are available to you in your community, like first-time homebuyer programs. And then at the latter part of tonight's class, we're going to look at the buying process. Now, after I leave tonight's class, hopefully I'll be encouraged that maybe I can achieve this goal of homeownership. Well, I'd like you to walk you through the process of buying. And that's one of the bigger questions I get from a lot of clients that I work with throughout the country, which is, now, where do I get started, Jason? How do I begin the process? Where do I go? How long is it going to take for me to buy my house? Those kind of important things are going to be answered during our workflow discussion. All right, so that's kind of our discussion for tonight, and really excited to take you guys on this journey. And let's kind of launch into our discussion by thinking about really, or asking the questions of ourselves, is does home buying really make sense for me? And that's the question we do have to ask ourselves, because again, it's going to be one of the biggest financial decisions you make. Now, when you think about home ownership, there's a lot of great things that go into home ownership, like stability of housing payment. I don't have to worry about my landlord that's going to come to me a year from now and say, hey, guess what? Time to renew your lease. Now we're going to jump the rent by 5%, or you can go month to month, and now your payment's going to be $300 a month higher. That doesn't happen with home ownership. Now, when I do achieve home ownership, at some point in time, I might have the opportunity to lower that payment through refinancing of my home. Those are things that homeowners can do when they do have that ownership interest, because now as the market comes down in interest rate, they can look to refinance to a lower rate. Because let's face it, interest rates are a little bit elevated levels right now, but homeowners do have opportunities to refinance when it does make sense. This is an asset that should grow over time. So we want to have this asset work for us. So we purchase a home at a certain price. That home will appreciate over time. Sometimes it's quicker than other timelines, depending on where I'm going to buy in the market and what I'm buying. But ultimately, that home will appreciate in value. And then each month, as I'm making my mortgage payment, I'm paying to my principal balance and my mortgage balance is going down. Now, as I create more separation between those two numbers, that creates home equity for myself. And for most of us across the country, that's our number one asset if we're a homeowner next to, let's say, our retirement account. So we really want home equity to work for us. Homeownership can be transformational for our clients. And what I mean by that is that equity appreciation that you see over several years can create generational wealth for families. And it can also be the springboard into buying another home. And the other thing that a lot gets lost quite often is tax benefits that come along with homeownership, potential tax deductibility of interest. And when I decide to make energy efficient upgrades in my home, that can also create opportunities to really preserve or create tax savings for myself. So as we're thinking about our budget towards homeownership, and as we kind of build in some of those data points like tax savings, equity appreciation, I wanted to walk you guys through one of our calculators, and it's called our rent versus buying calculator. And it allows us, and I'll screen share it here with you guys. This allows us to kind of frame up what it could look like if I continue to rent over the next several years. But how does that compare if I'm a homeowner? And so for the sake of time, I've actually kind of pre-filled out our calculator here. And I would encourage you, as you get these slides back, walk through this exercise yourself. But there's also other calculators that you can dive into, like our affordability calculator, of course, the payment calculators, and then for existing homeowners, a refinance calculator to see if that makes sense. So let's kind of take a quick peek at this. So let's assume that I'm going to buy a house for $400,000. And the minimum down payment on a conventional loan for a first-time buyer is 3%. So that's essentially the down payment. Now, there's also other expenses like closing costs and prepaid items that we'll talk about later. But at face value, you ultimately will be putting 3% down as a minimum. That means you're financing 97% of that purchase price, or $388,000. We plugged in the interest rate in the market, could be higher or lower depending on when I buy. Generally, we're going to be electing a 30-year fixed mortgage. Most clients are going to be looking at 30-year loans. And then let's assume that I'm going to buy sometime in October. Now, when I put less than 20% down, I'm going to have mortgage insurance on my home. Mortgage insurance, which we'll dive into a little bit later, is based upon credit score, down payment, and how much I finance. So we have a factor for mortgage insurance. And then we have homeowners insurance, what our tax rate looks like for the community that I'm going to buy in. And then maybe I'm going to purchase a condominium or a townhouse. Then I would have HOA dues that will vary based upon, what they are charging for participation in that community. And then some of the other assumptions, which are really important, is what tax bracket am I at? Because that's going to influence my tax deductibility of interest. How much my maintenance costs are going to be for my home. Am I buying an older home or I'm going for like a brand new home? That would trigger some expense from that we want to calculate into our budget. And then eventually, I'll probably sell my home, right? So I want to use that as maybe the launch pad into another home, maybe different community, larger home, whatever the case may be. So we want to factor in selling costs, appreciation rates, how much is my home going to go up in value each year. So that's all in the set of home ownership, right? So that's all in that column. Now on the other side of it, I have my rent situation, and we use someone that's paying $2,000 a month in rent. That could look different depending on where you're currently renting today, but let's use $2,000 as a baseline. We also want to factor in things like renter's insurance, appreciation, which basically means my rent going up each year. So that's in our rental column. So not as many attributes that go in that column. Now, when we kind of build this into our calculator, we first want to look at how long is it going to take for me to break even? Like I'm going to have to invest money like down payment, closing costs, prepaid items. Like how long is it going to take for me to start turning a profit on that investment? Well, according to our calculator, it's going to be about 3 years. The 3 years is the break-even point when my investments now will kind of get there. And then anything beyond 3 years is now profit for me as a homeowner. So I recommend clients are at least get into a break-even of 4 years or less. So this certainly hits the mark. I think where it gets a little bit more intriguing for our home buyers is when we span further out. Like let's say I hold on to this home for 10 years. Now my gain opportunity of owning versus renting is over $100,000. And that is a game changer for many. I can't tell you how many clients that we've helped over the last several years that have come back to us and said, hey, Jason, guess what? I have $150,000 in equity. Now I'm looking to go buy this next home of whatever value, right? And so I think, when we're thinking about home ownership, yes, we obviously have to consider budget, but I think we also got to look at it. What are some elements that go into the upside of home ownership that I don't realize today as a renter? And I think this calculator like this can really help frame that up for you. And then of course, last section is just total equity. So obviously you're buying a home for 400,000 over 10 years, maybe it goes up to 600,000. Who knows? Depends on what that's going to look like with just the overall market conditions. But certainly that is where we kind of see what should be intriguing to us as homeowner, not only creating affordability for ourselves, but the upside of ownership. Now, my entry point to home ownership is also going to be built upon what's the housing market looking like? Where do I want to buy? What's out there that I want to purchase? And what's the price point, right? Now, if we're looking in the state of Georgia, for example, Georgia, along with four other states, has the highest level of inventory right now in the market. Now, those states that have the highest level of inventory include Georgia, Florida, Colorado, and Texas. So I would categorize those as buyers markets. Other markets, let's say California, for example, would be more of a kind of a midpoint, probably leaning more towards like a seller's market today. Here's nationally what we're seeing. I know we have a lot of tech alumni kind of all dispersed all across the country, so I don't want to make the assumption we're all looking in, Georgia, for example. I know there's a lot of us in the Atlanta area, but I do work with a lot of clients in California that are considering the California market as well too. This gives you a national snapshot of kind of what's happening with home prices. Home prices are up year over year. So we have about a 2.0% year over year increase. What I was looking at is number of homes sold. So, things have kind of picked up with units sold across the country. When we're looking at the housing market in general, we've had some challenges from just a supply, so options for buyers in the market. We expect 2026 to be a little bit of a reset in the housing market with a little bit better affordability. Now, we didn't anticipate in our forecast the conflict that arose in the Middle East. So that kind of took things off the rails a little bit. And it's created a little bit of volatility for sure in the interest rate market. I will say it hasn't slowed down the pace of buyers entering the market. And I think some buyers are starting to realize there's some opportunity cost of thinking about purchasing today for sure. Price growth is expected to still be modest, and we're not going to really see any big jumps in purchase or sales prices in most markets. We might even see small dips in the market, especially over saturated markets or oversupplied markets. We might see prices come down a little bit. We've already actually seen quite a bit. In about 40% of all of our transactions that we're a part of today have some type of seller concession or price reduction. So seller concession means the seller has contributed monies toward closing costs to help the buyer, or they've reduced price down. So that's encouraging to see that in so many transactions. And then finally, inventory levels will probably improve a little bit in local markets. That is a good sign for us because, like I said earlier, over the last couple of years, we just haven't had a lot of options for buyers out in the market. I've always asked, when should I enter the market? And I do think there's opportunities in today's market. When there's concerns about what's happening in the economy, it can create some pause for many buyers. But I do think those folks that are financially fit do have an opportunity to jump into the market and capture some opportunities. If you just ask some of our clients that decided to wait back in 2022 or 2021, they clearly missed out on maybe lower interest rate environment, but certainly where the market has since gone from an equity appreciation perspective. Here's another kind of forecast that we looked at here, and this was built prior to what's happening in the conflict in the Middle East, but we expected rates in Q4 to go to the low sixes. Still think we have an outside chance of that. We'll have to see what happens with some of the monetary policy out there. Existing home sales, you can see kind of an increase year over year, median home price going up just slightly, and then year-end inventory lifting year over year too as well. So again, better supply out there for our buyers, which obviously gives us more choices. And in some markets, gives you a little bit more leverage, certainly the oversupplied markets. Well, interest rates can also play a role in our decision to purchase and when we purchase, right? There's a lot of volatility in the market. And when we look at kind of what's happening with interest rates on a day-by-day basis, we have to pay really close attention to what's happening in the economic headlines, whether that's what's coming in with, say, a consumer price index report that measures inflation that just got released on Tuesday, and that was better than expected. So that helped improve the markets, or what's happening with labor markets, unemployment, new payrolls, jobs created. But we also have to now look at what's going on with oil prices, because with the Middle East conflict right now, it is pushing oil prices up. So the higher that tension gets, the higher the prices go in oil, and that does have a negative impact in interest rates. So this chart really kind of depicts that. I mean, you can see just the really, especially in this last 90 days, the really choppiness in the interest rate market has been a bit difficult to navigate. Now, we're certainly at lower levels than we've seen, say, a couple of years ago. And I do think we'll trend down lower. but it will be data dependent on what the Federal Reserve is seeing with inflation in the markets and the health of the labor markets. That is going to really kind of be their guiding light in terms of what they decide to do as it relates to any type of Federal Reserve cuts. Now, we do have a new federal chair. Kevin Warsh is now at the helm. I think he was just doing some testimony on Capitol Hill. And so obviously everybody's kind of watching what his moves are and what he will do with any type of federal funds rate cuts. We're obviously watching really closely as well too. Hopefully at the next meeting, we may see a pause and hopefully not any type of increase in rates, because obviously our housing market can't afford that in today's interest rate state. Now, interest rates are not the same for all buyers. I think that's important to understand. There's different things that go into interest rates, like credit score and your eligibility for a specific product, the loan program that you elect, how much you put down, how much you finance. And then you can also buy points in your mortgage. And we don't generally recommend buying points, but essentially what points are is you're paying additional funds out of pocket in order to lower that interest rate. And so usually a point is the equivalent of 1% of your loan amount, and then it translates to about a 0.25% reduction in rate. But the downside in today's market is that it takes about 4 years to break even on those investments. So it's really not a great investment right now, because many of our clients that are buying in today's market are probably going to consider refinancing in the next 2 to 3 years. So it just doesn't make a sense to invest a lot in discount points. Now, one of the questions I get a lot is, well, what is APR? And APR stands for the annual percentage rate, and essentially captures the closing costs as a percentage in the first 12 months of your loan. And that's really important to understand, because as you're comparing lenders, especially those of our clients that first maybe go online to see what the average interest rate is at, you may see two lenders side by side and they're providing you the identical interest rate, but you have to kind of peel the onion back a little bit. And what I mean by that is APR is going to show those closing costs as a percentage in the first 12 months of your loan. So if I have lender A here that's offering me a 6.13 rate and lender B is offering the exact same rate, I want to dig a little bit deeper if I see that APR going higher of one than the other, because what that means is those fees are look a little bit higher. And you can see that in our cross comparison here. To get that 6.13 rate, maybe with lender A, I'm charging $3,500, $8,200 with the other lender. So really important to understand that, because, it's obviously the interest costs can be significant for you, especially as you span that over 30 years. It's our role in guiding you through homeownership is to provide the lowest cost option for you, and of course, help you meet your financial goals. So we're designing an affordable option for you in homeownership. Now, credit plays a big role in your product selection, but also interest rate and mortgage insurance, which we'll talk about in just a bit. I wanted to give you some just tips around credit. And then we'll kind of look at maybe some areas of opportunity that you can kind of take away from this section of class. These are the minimum credit scores for some of the loan products that are offered by most lenders, including APM. So usually the lowest credit score we can go down to is about a 580 credit score. Now, we get credit reports back from all three agencies, TransUnion, Equifax, and Experian, and we take the middle credit score of all three agencies. So if my highest score is 740, let's say my middle score is 720, and my lowest score is 700, we're going to take the 720 credit score for qualifying purposes. Now, if I decide to apply with my partner, maybe my partner's middle score is 680. Well, that could impact my interest rate, because they're going to have the lowest middle credit score between the two of us. So we want to be very strategic in how we design financing options and see what makes the most sense for you, because our goal is to deliver the most inexpensive product for you when it comes to your home financing. Now, there are 3 different models to credit scoring. There's mortgage, which of course we're going to use for your home financing. There's a car loan model, and then there's a credit card model. If you are subscribing to something like, say, Credit Karma, they're going to use the credit card model. So it might look a little bit different in your score representation there than it does on the mortgage side. So I get a lot of questions from clients of, hey, Jason, Credit Karma says I'm 780, but then you pulled my credit in with 760. I'm not trying to, I don't understand that. And so that's the reason why, is because the risk model is different in credit card versus what it could be on the mortgage side. Now, if you've had any past challenges with your credit, this is a matrix that you can use to see how long those negative items will stay with you on your credit. Now, if you've had something like a late payment, it's going to impact you more significantly in the most recent 12 to 24 months from the date of the event. So if I had a late payment on my student loan, say back in October of last year, I'm probably still feeling the effects of it in my credit score. But as I move further away from that late payment, I'm probably going to see some organic growth in my credit score. Now, this is a FICO score calculation for mortgage that I want to walk you through. So my hope is in this section is that you're going to say, hey, oh gosh, there's an area of opportunity for me in my own credit score. And then I can start working on that as one of my takeaways from class. The first section is probably not super within our control, which is length of credit, because that's ultimately looking at how long have I had credit established. As my credit file matures, then I'll start to see that improvement in my credit score. Now, one of the things we can control is how much credit am I trying to apply for. So we really want to be limited in new accounts that I'm trying to open up. I want to really avoid hard inquiries on my credit. Now, there are rules in place for hard inquiries that state that I can apply, like if I'm going out and buying a car, I can apply with as many auto lenders as I want, and it's the equivalent of one credit inquiry as long as I do it within a 30-day period of time. That same rule holds true for mortgage financing as well. Okay, so we want to limit new account activity. We also want to limit hard inquiries. Now, one of the things we do a little bit different in our process is we only start with a soft credit check. And the reason why we do that is because a soft inquiry gives us all the data that we need to see with credit scores and outstanding accounts, but it doesn't impact your credit score. So we can meet for your virtual consultation, design some home buying options for you, understand more about your credit, but not impact your credit score. So we actually wait to do a hard inquiry in most cases until you're under contract with the seller to purchase your home. Now, this yellow section is probably the biggest area of opportunity for most of my clients that I work with, and that is around revolving credit. And we're looking at my credit usage on revolving accounts like credit cards or maybe even lines of credit, overdraft protection, that kind of stuff. So ideally, we want to keep our credit balances at 10% or less of the credit limit amount. Okay. Now, if I'm currently running a little bit higher and I'm at 80% utilization, my first action item is let's try to whittle that down to 50% or less. That's going to be kind of the marker to see some improvement in credit. Now, as I continue to pay down that credit card, we want to get to 30% utilization, ideally at 10% utilization or less. Now, here's a tip how to manage credit card debt down and get the benefits on your credit score. Now, if you look at one of your credit card statements, the creditor issues information out to the credit agencies every 30 days. And it happens on your billing statement date. And the billing statement closes out all of your activity from the preceding 30 days, like what your charges look like, maybe you took something back, maybe you paid something down. All of that gets captured in that 30-day activity statement. What I would encourage our class to do is try to pay down that account or ideally pay it off before the end of that billing statement date. Because if you can do that, then you're going to get a much lower balance that reports out to the credit agencies. That lifts your credit score because now your utilization has gone down. So great way to manage your credit card debt quicker and more effectively with your credit score. And then finally, there's payment history. And payment history is how I've paid my debt. If I've had any late payments, they're rated as 30-day lates, 60-day lates, and then 90-plus day delinquencies. So the more significant on the spectrum of late payment I am, the bigger impact I'm going to have to my credit score, especially in the most recent 12 to 24 months. Now, just kind of continuing on with accounts that appear on our credit report, I just wanted to spotlight student loans really quickly. If you're in an active repayment today, great. We can use that payment right away to calculate your expenses for your home loan qualifying. The challenge comes when I'm in a forbearance or I'm in deferment right now, because then in that case, I have to assess 1% of the balance as your payment on a conventional loan, 0.5% for an FHA loan. So those are things that we have to look at in qualifying for a mortgage. So I know many of our clients are having payments that are now coming online. Maybe they have to recertify for their savings plan on their student loans. But those are conversations that we'll have as part of your consultation, just to identify what that projected expense is going to be, to make sure it still lines up with your qualifying opportunity in home ownership. Now, we do take a look at things like credit and student loans and a number of other factors, because every loan program that we work with has a set of guidelines that we have to adhere to. So this is our product segment. Now we're going to give you kind of a 10,000-foot view of different products that are available to you in your pursuit of home ownership. The first product is a conventional home loan. That's under Fannie Mae and Freddie Mac. If I'm a first-time buyer, it's a minimum down payment of 3% on a conventional loan, up to a loan amount of $832,750. Now, if I'm in a different market that's deemed a high cost of living market, let's say I'm going to go buy out in Los Angeles, California, right? In Los Angeles, you can go up to $1,209,000 in total amount financed. You can do that, but the minimum down payment jumps from 3% to 5%. So that's called a high balance loan limit. Now, every year, Fannie Mae and Freddie Mac, which is FHFA, sets the new conforming loan limit based upon cost of living. So we'll generally get that posting about like September, October, and then we start kind of applying that to our programs. The next product is an FHA loan. That's a federally insured loan. FHA stands for the Federal Housing Administration, minimum down payment of 3.5%. And that loan amount's a little bit different. It actually changes by the county that you're going to buy in. Now, the product just below that is USDA. Now, USDA is also government insured. It's a little bit different though. It's designed to help clients that want to purchase in more lower populated areas. So we consider that like different rural areas. Now, the benefit is it's zero down payment. It's also going to have qualifiers around not only just location, but the income for that household has to meet the guidelines. Now, both FHA and USDA, as I mentioned, are government insured products. So they do also require you to be a permanent resident. Unfortunately, those changes were made last year. That being said, if we are a non-permanent resident, you can still get access to conventional loans. Fannie Mae and Freddie Mac still allow non-permanent residents. The jumbo loan is going to be for clients that need a little bit more financing that stretches beyond, say, the agency limits. Not typical for first-time buyers, but it can be. Just comes with a higher down payment requirement, slightly higher credit score requirements. And then our VA home loan is for our veterans that have eligibility under the product guidelines. And that's a zero down payment option for the veteran, a little bit more flexibility in the guidelines to encourage home ownership for the veteran. And there's really no maximum loan amount for our VA home loan product. Outside of these products, we do have some other programs that are available, like our physician's loan program that allows physicians to be able to have lesser down payments, a little bit less stringent on guidelines for student loans. So that helps our physicians as well too. And then, for our first-time buyers, some first-time buyers want to purchase multi-family homes, which would be like 2-unit, 3-unit, and 4-unit properties. You can do that under programs. Generally, it's not going to be supported by first-time buyer programs, but on a conventional loan, the minimum down payment on a multifamily home is 5% of the purchase price. On an FHA loan, it's 3.5%. All right, because I sometimes get some questions around that, so I thought I would throw that out to the group. And again, if you have any questions as I'm going through our content, just drop your questions in the chat or Q&A. We're also going to take some questions later on when we get to the bottom half of tonight's class. Let's talk a little bit about PMI, and we're going to explore PMI not just from one side of it. It's actually there's two angles to PMI. There's PMI for conventional loans. There's also MIP for FHA. A conventional PMI calculation is built upon down payment, credit score, and how much I finance. And PMI stands for private mortgage insurance. So it essentially insures the lender against default by the buyer, but the buyer is expected to pay for that insurance. And there is a cancellation option with PMI that once I have 2 years in my loan and 20 to 22% equity, I can apply to have that mortgage insurance canceled. Here's what a calculation looks like for PMI. You can see it at the bottom of the screen. I always point out to our classes that if you've been doing some searches online already, maybe using some online payment calculators, what I found in my experience and research is that those PMI calculators don't look totally accurate. I encourage you to use some of our calculators on our website. They're all calibrated to meet, those three characteristics. Now that's on a conventional loan. So Fannie Mae, Freddie Mac. Now on the other side of our slide is mortgage insurance premium. That's for an FHA loan, the government insured product. There's two forms of mortgage insurance on an FHA loan. There's monthly mortgage insurance, which is calculated at 0.55%. And then there's upfront mortgage insurance, which is 1.75% of my loan amount. Now that 1.75 is a one-time fee, but it gets baked into the total amount financed. Now, different than the conventional product, FHA has no cancellation option. So really the only way for me to exit mortgage insurance is if I refinance from a FHA product into more of a conventional loan. So when I think about product offerings and designing options for our clients, generally the FHA loan is going to be our entry to home ownership. It's going to have, especially if I've had some challenges from a credit perspective, or maybe my expenses are a little bit higher, because FHA will give us a little bit more flexibility from that standpoint. We would use FHA as the springboard into home ownership, and then maybe 2 or 3 years down the line, assuming we're in a good equity position, try to refinance into a conventional loan. We've provided the cancellation, or not the cancellation, but the calculations to FHA mortgage insurance, which you can see down here. That's what an upfront mortgage insurance premium would look like on a $450 loan amount. And then that's the estimated monthly mortgage insurance. Now, both conventional and FHA loans will also be complementary to first-time buyer programs, which we'll learn a little bit more about later on tonight. One other thing I wanted to kind of touch on as we're looking at like the products spotlight section here is that you will see online FHA loans tend to have lower interest rates, usually a quarter to a 0.5% lower than conventional loans. But what you don't see, which is kind of, again, behind the scenes a little bit, is the mortgage insurance costs are significantly higher than FHA. So you might see a 6% rate on an FHA loan today, maybe conventional 6.5%. But when you do the math, conventional generally is going to probably give you a more favorable opportunity, especially if I'm in the 760, 780 credit range, because I'm going to have lower mortgage insurance costs. All right, we're going to talk a little bit about income and employment as I kind of think about home ownership. And, as your lender, we're going to kind of look at income. We're going to do some analysis for certain calculations in your home buying plan. I did want to pass along to you some of the general documentation requirements that we're going to ask for as we build your home buying plan. And in our income section, I always like to kind of share with our audience different scenarios or questions that I get as I'm consulting with clients in different markets across the country. And the first question I get is, how long do I have to be on my job? And, really in lending, we're looking at a 2-year work and or education history. So I honestly don't have to be on my job for 2 years. I have to at least just show 2-year work and or education history. So what does that mean? Well, let's say I graduated from tech in the fall of last year. I just started my job in January. Let's say I'm in Silicon Valley. I'm working for a startup, but I just got there in January. We can still use that income because we can display a full 2-year history, at least, obviously probably more, with our 4-year work at Georgia Tech. So that would still qualify us for home financing. We just got to be able to show that history in qualifying income. Now, that's assuming I have a base salary or a 40-hour work week job. If I have variability to my income, let's say I have that same job, it's a base salary of $70,000 a year, but I also get bonuses or commissions. Well, in that case, those variable components like commissions or bonuses, those have to be averaged over 2 years. So I do have to show that I've been on the job 2 years to count those sources of income. Base salary, not a big deal. That can be added in right away, but it's the 2 years for the variable sources. That would also include a situation where if I'm a client that has an hourly job and maybe my hours vary quite a bit because I do get overtime, in that case, an underwriter would average your last 2 years of income just so we can get a good historical average of what that looks like. If I'm self-employed, that's a little bit different because I have to show 2 years of tax filings as a self-employed individual so we can average over the net income from your business for the last 2 years. So that would be someone that's also, doesn't have to necessarily be someone that built their own business. It could be also an independent contractor that gets like a 1099 and maybe files the Schedule C income. Let's say I work for 2 employers. Let's say I work for 2 different medical clinics, right? And I work 20 hours here, 30 hours somewhere else. That is another situation that will have to show 2 years of combined history at both sources of income. Now, other things come up too, like clients that are thinking about transitioning jobs. I've been working for, let's say, one company for the last 5 years, but I have an opportunity to increase my income by 20% and go to company B over here. I can still qualify with my offer letter from company B and use that to qualify for my mortgage. So if I'm going to jump my income by 20%, that's really going to help me get to the next level of buying power for my home purchase. We can do that with an executed offer letter and assuming we understand when you're going to start that new job. All right. And then just want to touch really quickly on some of our clients that are in the tech industry do have RSUs. Let's say you started for Meta or Google and you've been there for 3 years. If you've been on the job for 2 to 3 years, we can count an average of 3 years of vested stocks that are part of your RSU plan. So your restricted stock plan, and those can be used in the income calculation. And lastly, just want to touch on some questions I get around supplemental income. Sometimes we'll have clients that work 40-hour work week jobs, but then also drive for Uber or Lyft on the weekends, and they want to kind of count that into their qualifying income. We can do that, assuming we can show 2 years simultaneously with our 40-hour work week job and the self-employment income. Now, one of the things we look at is a comparison of income versus expenses, and we call that debt to income ratio. And it takes a look at your current expenses, things like your credit cards, your personal loans, looking at maybe a car loan. All those get kind of calculated into your current expenses, but we also look at your projected expenses when it comes to the housing expense. Things like the principal and interest of my new mortgage, property taxes, homeowners insurance, probably mortgage insurance if I'm paying less than 20% down. All that gets baked into a calculation, and we've put that calculation on screen here to kind of give you an example of what we're talking about. We're assessing your expenses versus your income, and we can't have them exceed more than 45 to 50% of your pre-tax income. So in this example we have on screen, we have someone that's going to have about a $2,500 housing expense. They're paying currently $500 in debts, so they have $3,000 in outgoing expenses versus their $8,500 in income. So when we qualify them for their home financing, that tells us in the debt to income ratio that they're having about 35.3% of their expenses, or their income, I should say, going out to expenses. Now, again, the highest the guidelines will allow is usually 45 to 50%. The question I get from our clients is usually like, what should the debt to income ratio be? What do you think the right number is? I would say if you're below 36% or better, that's probably the number. But I do have some clients that are buying in high cost of living areas. You know, it might be a little bit more expensive to be in the Atlanta metro area as opposed to buying in, you know, Houston, Texas. You might have to take on a higher debt to income ratio in Atlanta than you would in Houston. But generally the affordability marker, I think, is around 33 to 36%, but the guidelines will let us go to 45 to 50%. Now, as we work with clients too, it's really important for us to design a home buying plan that's affordable, number one, and number two, it's sustainable, right? Because things change all the time for us financially. We want to make sure that you can, you know, weather any type of, you know, financial storms you have, and we get you in a really good position from a home ownership perspective. Now, the last kind of component that builds up a home buying plan is going to be down payment. Like, how much do I have in assets to go towards my down payment and my closing costs to purchase my home? So I want to share back with you some of the documentation and how we can validate some of your existing assets. And then I want to share with you a plan to help you save for home ownership. So when we think about how we can validate assets, of course, checking in savings accounts can be used. But the thing that I would like you guys to kind of see with when it comes to asset verification is we have to verify the seasoning of 60 days in those assets. So cash cannot be included. So any deposits that come in your bank account, we have to make sure they season out at least 60 days. Investment accounts can be used, 401ks, 403bs, brokerage accounts can be used. We would just encourage you to talk to your tax or financial advisor before you access those assets. And then gift funds can be also used in home ownership. Now, gift funds don't require any type of seasoning requirement. We do have to paper trail where those funds come from the family member, and we have to have them complete a gift letter. All right. We'll also talk about assistance programs in just a bit that can help you kind of close the gap from where you're maybe short today. But I want to kind of share with you a savings plan that we coach our clients on, and as we build up their home ownership goals and objectives. And so let's say, for example, today I'm paying $1,500 a month in rent. And after meeting with us for your consultation, we've set the marker of about a $3,000 budget when it comes to home ownership. So right now, we're probably going to go up in outgoing expense $1,500. If we're kind of struggling to meet the limits or the minimums, I should say, from a down payment and closing cost perspective in our savings goals, what I would encourage our client to do is let's start paying into our savings account like we're making that $3,000 mortgage payment today. So first of the month comes, send my landlord the $1,500, and then like clockwork, I'm sending an additional $1,500 into my savings account every month, and I do that consistently as a discipline for myself. At the end of 6 months, I have $9,000 built up in that savings account. Guess what? At the end of the year, I have $18,000. And if I'm pretty smart about it, I put into a high yield account and I'm getting 3% on my money. And that $18,000 now has $540 in interest that's accrued. And that can just continue to compound as I continue to save and as I kind of get closer to my financial goals with home ownership. So I know it's a really kind of simple calculation, but super effective in helping you reach your goals around home ownership. Now, first-time buyer programs can also help close the gap for you, as I mentioned earlier. So all across the country, not just in the state of Georgia or Florida, but all across the country, there are HFAs or housing finance agencies that are designed to support low to moderate income households in home ownership. And there's usually income limits attached to these programs. Someone that's a moderate income, depending on the state, could be at 100% of median income. In California, it's as high as 150% of median income. Or I could be a low-income housing buyer. That's someone that makes less than 80% of the median income. So nationally, Freddie Mac offers some incentives to low-income housing buyers. Both low-income and very low income is below 60%. Nationally, we have the DPA program Pathway that does not have any income limits, but it will assist you in 3.5% to 5% of your sales price and assistance, but it is only exclusively for an FHA loan. In Georgia, there's the DREAM program. It offers up to $10,000 to $15,000 in assistance options. California, because we do have a lot of tech alum here in California. So like to share with you, we work with Cal HFA, which is the housing finance agency here in California, as their #1 provider in first-time buyer programs. There's assistance programs that can offer anywhere between 3 to 6% in assistance. So that's awesome. And a little bit lower interest rates and lower PMI costs. And then in APM, we do offer the 1% down program. And that allows you to purchase the 3% down conventional loan. And if you contribute 1%, APM will grant you another 2% to make up your 3% difference to meet your minimum down payment requirements for your home purchase. Now, you do have to be considered a low-income housing buyer for that program. That's another great tool that you can use in home ownership. In fact, we had one of our clients from another partnership go into escrow in Kansas City, Kansas today, and they're using that exact program. So a really great tool to help you achieve home ownership. I wanted to give you an example of what it might take to get to the goal from an out-of-pocket perspective with home ownership, and then show you an example of one of the state programs that can help you kind of close that gap of what you need. So let's say, for example, you're buying a $450,000 home, and you're going to put down 3%, which is the minimum for a conventional loan, and you want to expect in your calculation to have closing costs be about 2 to 3% of your purchase price. And I'll explain what closing costs are in just a bit. But you're probably going to need about $22,000 to $27,000 out of pocket at a bare minimum. Now, where assistance programs can come in handy is, some assistance programs will cover that minimum down payment, like the Cal HFA product. So now you don't have to worry about your down payment. It's just all closing costs. Or you can layer on closing cost assistance and now get enough assistance to cover a majority of your out-of-pocket expense. Now, every state's a little bit different, so keep that in mind. So depending on where you're going to buy, you might not have as much resources, but there's certainly options out there, tools that you can use to help you get to home ownership so much quicker. So maybe home ownership before you started today's class was a 5-year goal. Maybe I've kind of changed your mind and said, hey, maybe it's a 1 or 2 year goal for myself. But there are resources that are out there that can certainly help you. Now, I did want to explain what closing costs are, because that is also part of that equation to what I need out of pocket to purchase my home. Closing costs include lender fees, but we also kind of lump those in together with property taxes, title or attorney expenses, escrow expenses, third-party charges like appraisal expenses. All those get kind of built into closing costs. Again, I generally recommend clients budget about 2 to 3% of their sales price in closing costs, but does not include some of the prepaid items when you purchase a home. Things like when you buy a house, you have to pay for your homeowner's insurance for the entire year. That comes out of your pocket. Prorated taxes on your house, prepaid interest that's part of the prepaids. And those are all things that we go through during your session, during a follow-up consultation. So once you're under contract with a seller, we'll have fees that we gather from a title office or an attorney's office, and we break down all the itemized fees for you. But I think it's important to understand that going into home ownership, what the expectation is around some of those expenses. Now, how are some ways that you can lower the costs, like closing costs? Well, obviously you can negotiate with a seller. And as I mentioned earlier, 40% of our transactions are seeing some type of seller concession, whether that's reduction in price or credits that can go towards these closing costs. So that can be super useful. Or you can ask the seller, hey, pay more of these costs versus giving me a credit. Those are all things that are up for negotiation during your contract. Also, as I mentioned earlier, there's closing cost assistance programs out there that can help mitigate or minimize at least some of those expenses that you have in closing costs. All right, so that gives you kind of a little bit of a look at the numbers behind the scenes in homeownership. Our last stop in our conversation in tonight's session is really an important one, and that's the buying process. And so after tonight's class, hopefully you found some encouragement. Maybe this has kind of sparked some thoughts for you around homeownership. And if it does, we, of course, would love to be a partner with you on the journey towards homeownership. And every client across the country that we support through our partnerships in the local community, I personally do a virtual consultation with them, a 30-minute deep dive session to help them understand their goals and objectives around homeownership. It's a free consultation we provide as our value to our community. And we design a home buying plan for them. And then the output of a home buying plan is to have them pre-approved. And just because you get pre-approved doesn't mean you have to run out and buy a house this weekend. It could be in a couple months. Frankly, it could be in a couple years. But at least you have the framework and goal set for home ownership. You know what it looks like for yourself. And many clients have come to a class and maybe a year later decide to kind of go through that experience. But I think that's a great next step after a consultation. Now, when you're ready to start actively looking in the market, It probably starts with some online search. So whether it's using some of the popular platforms out there or connecting with a realtor, and I would encourage you to do that because that realtor should be an expert in the market. They can filter different listings for you. They'll understand your objectives with community, lifestyle of home, school districts, walkability, whatever isn't really important for you in your home search. A realtor should be able to understand that and deliver there. The house hunting phase is probably the longest cycle of this entire process. And that's what I get one of my questions is, how long is it going to take, Jason? And it really just depends, right? Depends on where I want to buy, what I want to buy, and frankly, is it available to me? Well, if I do find the right home that I want to pursue, I'm going to make an offer to that seller. It might not get accepted the first time, might not even get accepted the second time, but eventually you will have an acceptance of offer with the seller. And that moves us to step 3, and that's called entering escrow. That terminology is different all across the country, but at the end of the day, it just means that you have an agreement with you and the seller to purchase that home. And now you've set forth in a contract terms and conditions and timelines of fulfilling that contract. Now, once I get advised of that contract being executed, I'm going to give you a call that day and say, hey, congratulations, you did it. You have a fully executed contract. We're now going to start the steps in your lending. And let's talk a little bit about what that looks like and schedule you for a follow-up consultation. With every client across the country, I personally meet with them to go through the design of their financing virtually, just to make sure everything is what we expected it, whether that be talking about interest rates, monthly payment, talking about the buying process, what goes next, understanding all the closing costs and prepaid items, really making sure we have a really sound plan for us in homeownership. And so we'll have that conversation within 2 to 3 days of your accepted offer. Now, as you get your offer accepted, you're going to have some action items on your side, which includes getting things like your deposit made to the title company, which is usually 1 to 2% of your purchase price. Now, that will count towards your total out-of-pocket expense. But is it a good faith deposit that gets included into the transaction? And that is all outlined in your contract with the seller. Now, part of that contract includes some stipulations like contingencies, that it gives you protections as a buyer that you can do some research on your property to make sure it's a great investment for yourself. That includes getting your house appraised, getting the house inspected, getting your loan approved. And so we want to make sure that we check all the boxes there. That contingency period can be as short as 7 days. It can be as long as 30 days. It just depends on how that is stipulated in your contract. Well, as we move through this buying process, we're going to move to step 4. Now, once you're under contract with a seller, we're going to start having some deeper conversations about interest rate strategy because, as I mentioned earlier, throughout the day, interest rates change. So beginning at 9 p.m. Eastern time to, 9 a.m. Eastern time to 5 p.m. Eastern time, interest rates changed by the minute, and they change based upon economic news that's coming in, things that are going on globally that can impact interest rates. So we're going to have some strategy conversations around that because our goal is to lock you in at the lowest interest rate available. Now, step 4 is going to be the processing and the underwriting of loan, kind of more of the administrative tasks behind the scenes, verifying your employment, assets, things of that nature. We want to kind of prep everything for the underwriting process, which is step 5. And that's where an underwriter is approving your loan. They are going through and just verifying that everything matches up for your program. That probably takes us about 3/4 of the way through the process. Now, through every milestone, you're going to be getting disclosures sent to you that are electronic form that you'll sign, and everything will match up to what we reviewed during your follow-up session, which again occurred within a couple days of your contract timeline. Now, step 5 kind of gets us almost to the finish line, but before we do, we're going to send out a final closing disclosure to you that gives you a 3-day cooling off period before we sign final loan documents in person. And that's the only step in this process that is in person, other than, of course, getting the keys to your house. But at the closing stage, we're going to be signing final loan documents with an attorney or title officer, maybe even a notary, depending on what state we're in. We'll also wire the final funds for our transaction that day. As your lender of choice, we'll also wire in the final funds. That money will get all reconciled. And then once it does, they'll record documents with a county recorder to transfer the ownership called a grant deed. They'll also record a deed of trust for the loan that you're taking out with us. And once we get confirmation that those items are all on record, we get a chance to give you a call and say, hey, congratulations, you did it. High five, you're now a new homeowner. Time to fire up that moving truck, get your keys, and start moving. So that is a huge day of celebration. Just before today's call session, I just got a chance to talk to one of our clients in San Jose, California, to congratulate them. They get a chance to move in this weekend. So obviously it's a huge, huge financial milestone, and we want to be there to celebrate with you. our relationships with our clients are a little bit different. They don't actually end there because part of our aftercare, we always want to make sure that we're adding value to you as a client, which includes providing tools like our HomeBot system so you can manage what's happening with home equity on your home. You can use some calculators to help you accelerate principal payments on your home mortgage, and our rate watch notification system to be really top of mind if rates go lower after you buy your home, and identify areas to be able to help you save money. And certainly checking with our clients at least on an annual basis just to see what's happening. We understand things change all the time in the finances for our clients. We want to be there as a resource for you. All right, so that's a little bit about the buying process. Well, how do we move forward if we're interested in building our own home buying plan? Well, I would love to have a one-on-one virtual consultation with you to design your own home buying plan. It's a very simple process. It starts with an online application. We only do a soft credit check. You'll also upload some documents, and then you'll schedule a virtual session using our scheduling system, which you can see the link here. And we'll meet for 30 minutes just to do a deep dive and just really understand more about how we can support you in the journey towards homeownership. It is a no-cost option for you, or obligation. You don't have to feel like you have to run out and buy a house tomorrow. We just want to kind of give you the framework for what homeownership could look like for you. Now, you might have some questions after tonight's class that you don't feel comfortable asking in a session like this. Feel free to schedule an introductory call with us. We'd love to be able to kind of answer those for you. Our consultative process is significantly different than what most lenders do. Usually it's kind of just order taking, telling you what your interest rate is, your payment, and giving you a pre-approval. We look at homeownership so much more than that because we understand this is going to be a major financial decision. So we want to pour all of this education into you this evening and then really kind of go and customize it for you as part of your home buying plan. This is what a consultation looks like for you. So those are all the topics that we'll cover during your 30-minute session with us. We try to embrace technology too in our process. So whether that's being able to start your process and track the process through mobile, or it's using some of our AI features to create efficiencies in our process. We always try to lean into technology, but I always like to share with our class, it does not replace our human touch, the human element of home ownership, because we want to make sure that we're there to help support you every step of the way through this journey. Whether it's a simple call to say, hey, we're good, we're going to get your underwriting approval, or to talk through some current concerns about an appraisal or whatever the case may be, we want to make sure that we're here as an outlet for you. As I close out tonight's session, just want to remind you, with our Georgia Tech Alumni Partnership, not only are you getting access to our classes quarterly, but we also pass along discounts in our services and really try to design competitive options for you in your homeownership plan. So getting you best in market interest rates that we can offer. And of course, just trying to give you as much value as we can as we guide you through the homeownership process. Now, if you're interested in homeownership, I'd love to get connected with you. But if you also have friends, family, and coworkers that would like just to learn more about homeownership, we have other classes throughout the year. We'll be fortunate enough to teach over 10,000 future home buyers in homeownership this year. So there'll be other classes available. So if you'd like to kind of pass on this, we'd love to be able to see them at one of our upcoming classes. But of course, we're recording tonight's class and you can access that up on our YouTube channel. As we kind of wrap up and hopefully open up some questions, I just want to share with you one of our testimonials from one of our tech alum. It's a long one, but I just want to kind of give you some of the highlights from Hannah and Jesse. I helped serve them in home ownership in the fourth quarter of last year in October. Just an awesome couple, and they're just very super detail oriented. We were able to give them a lot of great information. We were able to lock them into a low interest rate. They were saving up as much as they can, and they were able to get a good down payment together. I think they put 10% down to purchase their home. We were able to design a budget for them, and some of the things that that really kind of stood out for me in their testimonial is just constantly keeping them in the loop of the progress, being efficient in the process for them, creating a streamlined process, and creating a process that they feel like they could tell their friends and family about. That for me is a ringing endorsement. So I know in an educational setting like this, it's great to hear kind of theory, but it's always important, I think, to be able to share back with you what our community says about us, because we really take a lot of pride in what our community says about us. And there's certainly other testimonies you can check out on our Google reviews. Check out what clients say about us in some of our Reddit communities across the country, because we're really proud of what our clients think of us. And we look at homeownership a little bit differently. We're really passionate about just serving and helping people in homeownership. It's a different outlook than probably most lenders do. And that's why, we want to kind of give you some value add like we had in tonight's class. Well, I'm at the end of tonight's class. I got a few minutes to spare, but I'm more than willing to stick around for any questions you have. I did want to send along my contact information. So if you need to reach out to me, love to be able to hear from you and see how I can help support you. Any questions from our class as we get wrapped up here? And you can, again, you can use the chat or Q&A. I'll kind of check out those questions. I know in some time zones I'm right before dinner, so you guys might be getting a little hungry here. So question was, do you work in New York? So we actually are almost ready to go in New York. So I don't know what your timeline looks like for buying. That is the one state that we've kind of been a bit delayed in getting off the ground with licensing. So maybe talk to me offline if you don't mind. And I think last time I checked, we're only like 3 to 4 months away from that. So I think we're almost there. So depending on what your timeline looks like, we might be able to help you there. I wish I was buying in New York, if that's any consolation. I love New York. New York's a great state. All right. I hope the no questions mean I was super thorough and you guys enjoyed it. Hopefully you guys enjoyed the class. We really try to provide good value, and we try to use the feedback we get from clients during our consultations and try to build that into our plans, because we want to give you stuff that's relevant, that's like going to help you guys make a great financial decision. So hopefully you got that in tonight's class, and hopefully you got 1 or 2 takeaways that have kind of changed your mind around home ownership and just give you a little bit more insight to what this could look like for you in your financial futures. All right. Well, you guys are all staying online, so I think everybody is good. Thank you for the kudos there. I appreciate that. Thank you so much. Yeah, and I do hope I get a chance to meet with you guys. And I'll probably usually we try to go on campus to tech here. I think I'll probably be out there maybe latter part of this year. So we'll get a chance to see some of our representatives at a conference here in the next week or so. So, all right. Well, if you guys don't have any questions, I'll let you guys enjoy the rest of your evening. Have a wonderful night, and I'll talk to y'all soon. Good night.